Thrilled to have with us back Scott Varney and Ruth Benjamin, tax strategists. They've been with us before, and due to popular demand and requests from our audience, we've brought them back again to expand a little on some of the topics that they talked about last time. So we do have some new stuff to go over. And also, before we start, as usual, we are recording this whole thing so that you can get it tomorrow via email. I will be sending it out to you along with the speaker's contact information, so you can get in touch with them if you need to, and also the PowerPoint slides. If you miss anything, don't worry, we'll be sending that over to you tomorrow. And now also, I'd like to give a more formal introduction about Scott and Ruth for those of you who have not seen them yet. Scott Varney is a capital gains tax strategist, as well as a financial services professional. He helps clients think through options to defer, reduce, or eliminate capital gains taxes upon the selling of a highly appreciated asset. And in this case, that's apartment buildings. He has a background in real estate as a top 1% producer nationally in the realm of residential real estate. And he enjoys being with people and loves the opportunity to help solve challenging issues, which I'm sure many of you have. Ruth Benjamin is also a capital gains tax strategist. And I have from her a quote that I think sums up what she does pretty well. She says, "I have a passion for helping sellers of highly appreciated assets sell their property without paying capital gains tax at the time of sale. Initially, my role is to educate sellers on the various strategies available, and there are some IRS-approved methods to accomplish tax deferral. From there, she connects her clients with the appropriate professional who can analyze your situation and advise you based on your individual circumstance." So thank you so much for being here to you both. I really appreciate you taking the time, and I'd love for you to share your screen so we can start the presentation. I know you have so much information to go over, if this was anything like your last presentation.
All right, I will get Sharon, and just so that you know, as you put questions into the chat box, Ruth, her fingers are going to be smoking. They're going to be moving so fast. She will be answering a lot of the questions along the way. So that being said, we're going to go ahead and get started. So quick disclaimer, while this is general information about various capital gains tax strategies, it does not constitute legal or tax advice. The best way to get guidance on your specific legal issue is to contact an attorney. We'll help you to take a look at your case and help you think through the options, but we always recommend that people talk to their CPA, their enrolled agent, their tax attorneys. If you leave this webinar overwhelmed and confused, you're normal. Don't feel bad that this is kind of going way over your head. The goal here is really, we're going to give you a lot of information, and that it's really to help you to be more aware that there are a lot of options out there. I just recently wrote an article for the AAOA so that it'll be coming out soon, if it hasn't already, on being stuck in a 1031 system. People think that they're stuck. You either exchange or you pay taxes. And there's a lot out there. And that's the goal today, is to help you to see you have options. All right, the current capital gains tax rates, 0, 15, and 20% brackets. Now, understand this about federal capital gains tax rates. They're not like your income tax rates, which are progressive. You're going to have a little bit in the 10% and the 12%, 22 and 24 and 32. So here with federal capital gains taxes, if you hit the 20% bracket, then everything is taxed in the 20% bracket. So it's not progressive. And that's something that people don't understand a lot of times. They try to figure out their tax bill and they do it progressive, much like income taxes. Now, these rates are subject to change at any time. Currently, the proposed rate is to increase it from 20 to 28%, and then anything over $1 million in capital gains tax rates are to be increased to 39.6%. Now, that is a current proposal. That doesn't mean that's what it's going to change to. There's a lot of arm wrestling and negotiating that has to be done, but that's what we're looking at right now. I'm always looking at what's the proposed rates. And then you also have the net investment income tax, which is, excuse me, what we know as Obamacare. That's 3.8% plus your state capital gains tax rate. So capital gains rates can be significant. Plus you have depreciation recapture that can give you a hit, or even a debt over basis tax that could give you a hit. And a lot of people don't even know about that. All right, the recent 1031 exchange proposals, again, proposals are that the investors will be capped at $500,000 in capital gains tax deferral per person per year. So if you're married, it's $1 million. So if you have significant assets that you are looking to sell, you will only, as a couple, get $1 million in deferral. So if you have $2 million in gains, you can defer $1 million, but you're going to have to pay the taxes on the other $1 million. So in that year that you sell the property. So that's going to be a significant hit to a lot of our clients, should they actually approve of this. So it's been negotiated back and forth whether or not to eliminate 1031 exchanges, and that doesn't make sense. So this is a way to actually still get taxes from those who are considered among the higher net worth. All right, the agenda for today. So we're going to talk about different deferral strategies, plus one income tax strategy if you're in the top 2 or 3 income tax brackets. The timing is critical. Some of them have to be set up before closing of your asset. Some of them can be done within a 1031 exchange's 45-day identification period. Some of them can be utilized to rescue a failing 1031 exchange, not a failed, but a failing exchange. And then some of them can be utilized after closing, but there's no 1031 exchange involved. And then, of course, we have an income tax mitigation strategy. And if you have a QR code reader, we do have an event coming up that is, we think, potentially the best tool for mitigating capital gains taxes and income taxes from rental properties for the rest of your life. So, so pull that up if you have a QR code reader, or you could take a picture and it reads as well. All right, these types of strategies you need to set up before closing. So quite often we get clients calling us going, I sold my property in June. What do I do? Well, these have to be set up before closing. Charitable trust. That is a very popular strategy around the country. This is a means to eliminate capital gains taxes for any appreciated asset or business. The asset must be in the trust when it is sold. So you set up the trust, you donate the asset to the trust, and then it is the trust that sells the asset. Investment properties can be part of a charitable trust, and an appraisal will be required to determine the value of the asset donated to the trust, because you are also going to get a significant charitable deduction. Now, the cost to do such a strategy is typically about 10% of the value of the asset has to go to charity of your choice. So you have 10% plus attorney's fees to set up the trust, and $4,000 to $7,000, it could be more. Now, if you sell the asset and you immediately give 10% to charity, that's what they call a charitable lead trust. If you sell the asset and the last 10%, after all distributions have been made, goes to the charity, that's what they call a charitable remainder trust. Now, there are limitations with these charitable trusts. Proceeds are not fully liquid immediately. There are different formulas used. You're basically going to have distributions that start a year later, and you're going to receive anywhere from 5 to 50% annually. Now, the higher the distribution, the lower the taxable deduction you get to receive that you're carrying forward up to 5 years. So you have to work with your attorney to see what is the best formula for your case to get as much tax deduction as possible, and while getting as much cash out of the trust as quickly as possible. And typically the first distribution starts a year after the trust is set up. Upon the sale of the assets, monies can be invested while in the trust. So you sell $1 million property and you're waiting for distributions, you can call your financial advisor and have them invest the funds into stocks, bonds, mutual funds, annuities, whatever it is you want, while it's in the trust waiting for distribution, so that you don't lose time and lose value of the asset. So you can be growing your money in that trust and get tax mitigation along the way. One of the limitations is that the asset has to be free and clear of debt. Some attorneys believe that there is an exception if the debt is at least 5 years of age. So if you have a mortgage on it and it's 6 years that you've had that mortgage, that's fine. If it's 4 years, they're going to have a problem with it. Many attorneys, though, want it to be free and clear of debt. So that is a limitation. And just so that you know, and a lot of financial advisors use trust as well. The nature of charitable trust, if you put an asset into a trust and then you sell it, the longer you go before selling it, the better. So you want to have at least a separate tax reporting year. So put it in 1 year and sell it in another year. But some tax professionals say you need to wait for it at least 3 years before the IRS comes in and unwinds that trust and calls the taxes due. So you have to talk to a tax attorney to make sure it's a good fit for what you plan to do. All right. This is an incredible tool. This has a lot more advantages than just the capital gains tax mitigation. It's a dynasty class of trust. These types of trusts may mitigate capital gains taxes by deferring them down the road hundreds of years. Captain Picard on the Star Trek may still have the tax deferral from today. So it could be deferred hundreds of years, generations. You could mitigate your passive income taxes. That's from investment properties, as well as stocks, bonds, mutual funds, cryptocurrency. So as those grow, you get tax benefits as well. And then active income taxes. So for those of us that have active businesses like myself and Ruth, who we are actively working in generating income, you could reduce your active income taxes by 50 to 70%. So there's an opportunity to mitigate your capital gains taxes and income taxes, not for W-2 employees, but for those who are self-employed. This trust also provides ironclad asset protection. One thing that people don't realize, they go, hey, I'm going to put my asset into an LLC. Well, that's wonderful. Did you know that 40% of the time that LLC is pierced in federal and state courts and you still lose your assets anyways? So this provides an ironclad asset protection that goes significantly beyond what the LLC is going to give you. This is the type of trust that, as John Rockefeller said, the key to success is to own nothing but control everything. So you're going to sell your assets to the trust. The trust owns the assets. So if you get sued because you're at fault in a car accident and there's a $2 million award because you're at fault, they do not have access to the assets in the trust. That's significant for a lot of our clients. It avoids probate upon death. It avoids the gift and estate taxes. It ensures transfer of your assets to your beneficiaries while protecting multi-generational wealth and accumulation. So the costs, typically a basic beneficial trust that covers the capital gains and the passive income taxes is usually $30,000 to $40,000. If you have a second trust added to that with the income, active income, you may be close to doubling that. But this, once you set it up, this is lifetime. It's not like a living trust that costs $2,000 to $3,000 and all it does is it avoids probate. This is what a lot of the wealthy do to mitigate their taxes. Now, the asset needs to be in the trust when it is sold. Again, this has to be done before closing. It has to be the trust that sells the asset, and that's very important. And, you know, there is no seasoning required with this type of trust. So if you do it in the same tax reporting year, that is defensible. But, you know, if you want to reduce chances of audits, it's best to set it up in 1 year and sell it in another year. Do advanced planning. But this is defensible, even if it's 3 months later in the same tax reporting year. And again, this works for cryptocurrency. For those of you who are building wealth in cryptocurrency, This is a great tool for mitigating those taxes. Now, the provisions of one of these types of trusts is a non-grantor, irrevocable, complex, discretionary spendthrift trust. And the non-grantor, irrevocable, and not self-settled provisions provide ironclad asset protection. Complex and discretionary provisions defer capital gains taxes, and many states. California is trying to go after trusts. We don't know if they're going to be able to get the taxes on these types of trusts, but you need to be aware of that in California. It may mitigate income taxes for passive income, rental income, non-qualified investments. So IRAs and 401ks cannot be used in this kind of trust, and income taxes for the self-employed. So that the two provisions there, complex and discretionary, will take care of the income taxes. And spendthrift is multifaceted. It provides ironclad asset protection as well as the tax benefits. Another form of tax deferral follows tax code 453. This is your traditional installment sale code. It was written in 1913, ratified in 1918. And so it's been around a long time. We know it as an owner carry. So this is where the seller, in a sense, becomes the lender for the buyer for a specific period of time. So let's say Ruth is buying my property. We set it up that she's going to pay me 10% a year for 10 years. Now, by doing that, I'm only going to have to pay the capital gains at 10% per year, each year for the 10 years. Some people do that so that they can spread it out and be in a lower capital gains tax bracket. And that is really helpful. Then you're only paying the capital gains for the portion you receive. Plus, of course, you're charging interest. And so you're going to have to pay ordinary income taxes on that. When the note gets paid off, if you have a significant balloon payment, let's say $500,000 or more, then we could actually still defer those taxes for 30 years using a tax deferred cash out structure. Now, I want to give you some insight in case some of you are thinking about doing an owner carry or anything in the installment type of code outside of a tax deferred cash out because you're wanting to spread out your taxes. Let me give you a little insight. We are at a time where that would actually be a bad decision. And here's why. The top tax bracket right now is 20%. The next bracket is 15%. So if you can get down to the 0% bracket, hey, go for it. But if you go from the 20 to 15 and they approve of the tax rates being increased to say 28%, the second bracket might be at 22 or 23%. So by spreading it out, you might go from 20, instead of going down to 15, you might end up going up to 22 or 23%. So you may end up paying more in taxes by spreading it out. So this is the time we've got to wait for them to make the decision on what they're going to increase the tax rates to. That way, moving forward, you have a better chance at saving on taxes. A structured installment sale. Same thing applies in terms of spreading it out. This is tax code 453. And then as you collect each year, you're going to pay the capital gains taxes and any ordinary income taxes on any growth. So this spreads it out. Same thing, structured installment sale. Now, some of the structured installment sales are set up so that the funds go to a holding company and the holding company buys an annuity from an insurance company. And then you can set it up that the insurance company is going to pay you over the course of, say, 5 to 40 years. And then as you receive each year, because you know the insurance company is going to be paying you, unlike an owner carry where some of you may be concerned that the buyer may default, which, by the way, I've known people who hope the buyer defaults because they get a big down payment up front again on the next buyer. They really make a lot of money by people defaulting. But here, you have a lot more security because the funds are coming from an annuity from an insurance company. So you could spread it out. But even though I like this strategy, again, this is a bad time to be looking at this type of strategy to mitigate taxes. Now, the annuity payments can be set up for 5 to 40 years. And in many cases, there has to be no debt on the property if the seller wants full tax deferral. So if you have some debt, you're probably going to have to take mortgage boot for paying that off, and then you can defer the balance of it. But again, this has to be set up typically in advance. In some cases, you can rescue a failing exchange with it. So we just have to look at your case. 1031 exchange. Now, this might seem to some of you kind of interesting that we're putting this in here now, setting up in advance. But I want you to know, I get lots of calls. Ruth gets lots of calls saying, I closed my property 2 weeks ago. The title company is holding our funds. We want to do an exchange. And we have to give them the bad news that, I'm sorry, the title company right now is just super nervous that they're holding your money. You already have what's called constructive receipt. The contract for an exchange has to be done and set up in advance of the closing. It cannot be done afterwards. If it's done afterward, if you try to attempt afterwards, it's too late. So that's why that's here. Now, this defers capital gains taxes for as long as you own the real estate. You can get going in an exchange chain. So you buy one, sell, buy, sell, buy, sell, buy, sell. That's a chain. And with that chain, the original basis is what they're going to look at for your capital gains tax bill. If you own it, now, a lot of people will continue to own the properties because they want to do what they call the swap until you drop strategy. That is, you keep owning the property, and then when you pass away, as the current law applies, and they're challenging that now too in terms of trying to take it away, you get what's called a step up in basis. You pay $200,000 for a property, it's worth $1 million when you're selling. Well, if you sell it yourself while you're alive, you're going to have to pay the gains taxes. If you pass away, then your beneficiaries get a step up from the $200,000 to the $1 million as the basis. So if they sell immediately, there may be little to no capital gains taxes, depending on the market, because some markets appreciate really fast in a hot market. Now, you have to replace with like-kind property of equal or greater value. That does not mean that if you have a single family rental, you have to buy a single family. As long as it's in the class of real estate, single family rentals, condos, industrial buildings, golf courses, retail space, farms and ranches, you'll see the list there. As long as you buy in the world of real estate, that qualifies. That's what you have to work through with your 1031 exchange accommodator. Now, what does not qualify are primary residences. Now, you have the 121 exemptions. That's the $250,000 per spouse exemption. Now, if you've owned it for 2 of the last 5 years and you've rented it for a time, you could possibly qualify to get both 1031 exchange deferral and also the 121 exemption. You have to work that out with your attorney. Second homes do not qualify. Flips, that is active. You have to own properties for a year and a day and have rented it for the 1031 exchange. So flips do not work, but they will work with that dynasty type of trust, what we have called the complex spendthrift trust. Developments and then real estate investment trusts. They are typically a membership interest in a trust and not exchangeable. But if your REIT is considered real property and not a partnership, then your 1031 accommodator can let you know if that will qualify. Excuse me. You have to replace debt with equal or greater debt. I put that in there. Ruth does a fabulous 1031 exchange webinar. And on our website, we have a recording on that. This is often a shocker to our clients. They don't realize that if you owe $200,000 on the property you're selling, when you buy the next property, you have to create $200,000 of debt. You have to replace the debt with equal or greater debt. Or you can pay cash to replace that debt out of your pocket. And so a lot of our clients will call thinking, well, I've got $300,000 left after the debt's paid. I'm just going to buy $300,000 worth of real estate. They don't realize they have to replace that debt. And they're not in a position many times, credit issues or whatever it is. Maybe they don't have a job now. They can't qualify. So that's a problem. The other rules, you have 45 days to identify a property, and you have 108 days to close the identified property. Right now, anywhere from 40 to 60% of exchanges will fail. And that's a problem. And so you want to make sure that you're working with an accommodator that can help you to rescue a failing exchange. Now, here's a little bit of insight that you want to know. If you do not identify a property, the accommodator can release the funds to you on the 46th day. But that's only if you do not identify a property. If you do identify a property and you do not purchase it, then the accommodator cannot release the funds to you until the 181st day. That's 6 months later after the close that they can release the funds to you. So you really want to take a look at some of these rules here when you're doing this. Make sure you work with an accommodator that will guide you to these things. All right. Now we're going to look at what's available within a 1031 exchange's 45-day identification period. This is really to generate mailbox money. For those of you that don't want to deal with the tenants, the trash, the toilets, and all of that anymore, but you want to keep in the world of real estate, here are some options. And these are also good backup options. So you go out there, you're looking for the properties, and you don't see anything you like, then in the last 5, 6, 7 days, you identify properties within this class. The first one being Delaware Statutory Trust, a DST. Now, this is not the same as the Deferred Sales Trust. So there are a couple of DSTs out there. Excuse me. These types of DSTs are securities regulated investments. It is a more settled tax solution. And understand this about capital gains taxes. Most of them do not have case law backing them. 1031 exchanges do, but you could still have an exchange disallowed by the IRS if you do not do it right. So everything is built on how it's set up, how it's managed, how it's reported. Everything is fact determinative. So when I say a more settled tax solution, there is an IRS ruling, but it still has to be done right. You own beneficial interest in real estate and not the real estate itself. This generates mailbox money plus future appreciation. You have passive income. You don't have to manage the property. The management is already put in place. And these are significant commercial types of assets or properties, apartment buildings with 400 or 500 doors. So this is in a different class of real estate than your typical single family residence. Now, the cost to do these types of DSTs could range anywhere from 8 to 15%. Now, this can be a part of a 1031 exchange process, but it does not have to be. So if you want to just invest in a DST, you're welcome to do that. You can exchange into and out of a DST, but you don't have to, again, be a part of that. You can just buy into it if you want. There is a limitation. You have to be an accredited investor. What is that? So accredited investors, 2 ways to qualify. You either have a $200,000 adjusted gross income as a single person or $300,000 AGI as a married couple, or you have $1 million in investments, asset value minus debts, $1 million outside of your primary residence. Those are the 2 ways to qualify. And they actually have ways to check, to confirm that. They have companies that will confirm that for DST specialists or opportunity zone specialists, those that require a accredited investor. And why is that there? Well, the government has decided that if you have that kind of income or that kind of investments, you're on your own. We're not going to give you any kind of protections. The purchase is not liquid, so you want to have your funds in there 7 to 10 years, and it is trustee controlled. So you don't have the flexibility that other tax strategies will provide you. There's also the tenant in common, known as a TIC. These are also securities regulated. You have co-ownership with other investors with proportionate ownership of commercial real estate. You can have 10 owners with 10% each, or 10 owners, one at 5, one at 13, one at 7, one at 22%. So it doesn't have to be the same amount of ownership. You can exchange into and out of a TIC, or you can buy into them. You have direct ownership in real estate, and you have the passive income because typically the management terms are already put in place. Now, here is a significant limitation. Unanimity of all owners in decision-making. That could be a problem. If you have a married couple trying to make a decision, have you ever had problems with making a decision, or even with a friend or a business partner? And that's just 2 people. You add a third, a fifth, a 10th partner, and that gets to be a lot more difficult. It might take 3 years to decide the color of a carpet in the foyer. That's how it goes. As a matter of fact, as an example, we know of a case where a group was selling their TIC. They got an offer in. One person would not sign off on the offer because they expected to get a certain amount of profit. Everybody else had to give up $200,000 a piece to satisfy the one to get them to sign. So that's the kind of control one person can actually have when you have to deal with unanimity. And there's also a lack of lending for TICs with more than 10 to 12 investors. Can you blame them? You can't even make a decision. It's hard to make decisions with lots of investors. Now, what about rescuing a failing exchange? Not a failed, a failing exchange. That's what we're going to look at now. What is out there to help you? There is a tax management memorandum that talks about moving funds from IRC or tax code 1031 to tax code 453. So the rescue options are within tax code 453, within the installment cell. Critical point. All of this hinges on hiring the right 1031 exchange accommodator to begin with. Not all accommodators, or some of you know them as intermediaries, will cooperate with the seller to release the funds to a tax code 453, IRC 453 strategy. For example, IPX is a wonderful 1031 exchange company. Nothing bad to say about them. All good. We know people in IPX. But here's how it goes. If you set up an exchange with IPX, you complete the exchange or you pay the tax. No other options. What they're going to do is tell you, oh, you're struggling to find a property? Go to a Delaware statutory trust. Identify a trust. That way you can complete your exchange. You have to find an accommodator that has it in their contract that if you do not find anything, you can actually move to tax code 453. They give you that option. My business partner, Ruth, has been doing exchanges for 30 years. Her contracts allow you to rescue a failing exchange. Now, one of them is what's called a tax deferred cash out. This can be set up pre-closing. You could choose to do this without doing a 1031 exchange, but this is also, it follows tax code 453, and it can be done as a rescue mission. You defer the capital gains taxes for 30 years. So if it looks like you're not going to complete the exchange, then you can still defer those taxes for 30 years. And again, we can do this for businesses that are selling. We're working on 2 deals right now with a $38 million deal and a $19 million or $18 million business sale. So this can be done for more than just real estate. But you defer the taxes for 30 years. The seller receives 93.3% of the net sales proceeds. That's the contract minus the closing fees within 5 days of close of escrow in the form of an investment business loan. So you can see here the cost to do this is going to be about 6.7% of the net sales proceeds. Again, contract price minus the closing fees, not minus debt, is what they base that on. You're going to get non-taxable loan funds and they are to be used for business or other investments into a financial vehicle of your choosing. So when you get those funds within 5 days of close of escrow, excuse me, then you can put it into any kind of business. So you can sell while the market's hot in real estate and wait till the market cools off so you could swoop in and buy something at a great value. You don't have to follow the identification period of a 1031 exchange. You could sit on those funds 1 or 2 years and wait. You could pay off debts on other investment properties. You can open a restaurant or a landscape business. Or if you're in real estate, like a lot of people that we work with, you could buy equipment, printers, computers, hire new agents, whatever it is, as long as it's a business. Or you can call your financial advisor and say, hey, I've got $300,000. Please put that into mutual funds. Let's meet. I need to invest. So you have some flexibility here where you do not have to buy equal or greater like-kind properties. And you get that tax deferral for 30 years. Now, the value of the tax deferred cash out, flexibility, again, you don't have to buy like-kind properties. It's a great exit strategy for those who want to sell and not deal with the tenants, the trash, the toilets anymore, so they can call their financial advisor. You don't have to follow the 45 and 180-day requirements that you have in the 1031 exchange. You do not have to do a replacement loan. So let's say you do want to buy more properties, but you want to wait. You don't have to replace the loan because the tax deferred cash out is the replacement loan. And then you have a significant increased depreciation available. And we'll walk through that here for a moment. And this is, for you numbers geeks, this is awesome. Let's say you bought a property for $250,000. It's a 1 to 4 family unit property. You've owned it for 15 years. You're selling it now for $1.2 million. That's like here in Silicon Valley. But you're not trying to retire yet. You're still in asset acquisition mode. So you sell for $1.2 million and you purchase for $1.8 million. Well, based on this example, you have, if you do an exchange, you have about $500,000 of depreciation still available, which is helpful to counter income from the rentals in terms of paying taxes. If you do tax deferred cash out, you actually have $1.26 million of depreciation available. Why? Because the only thing that you have for depreciation if you do an exchange, is for the next 12 and a half years, you get the balance of this available, plus you get to depreciate the difference between 1.2 and 1.8 million. With the tax deferred cash out, with the 1.8 million, you get full tax depreciation available. So depending on your CPA, whether they're going to depreciate 60 or 70% of that, but you get to start a whole new depreciation schedule for 27 and a half years. So that is significant. All right, a structured installment sale, which I talked about already, is a means to rescue a failing exchange, because that's also in tax code 453, but I'm not going to spend any more time there because I've already gone over that. Now, the other DST, the deferred sales trust, you can actually do this pre-closing and set it up accordingly, or you can utilize this as a means to rescue a failing exchange. This is, again, form of tax code 453, installment sale. It can be used to purchase real estate, diversified marketable securities, or a business. Now, one thing to note, all the other installment sales, you're going to be paying taxes annually, whereas the tax deferred cash out defers the taxes fully for 30 years. Here you pay proportionate taxes annually, so you're going to be paying capital gains taxes each year, proportionate amount, plus ordinary income taxes on the investment growth. A limitation. Now, this is in red because I want you to pay attention. No control. This is controlled by a third-party trustee. See, you are considered a creditor of the trust. As a creditor, you do not have the decision-making control. You might say, I'd like it in conservative or moderate or aggressive investments, but you don't get to make the decision what it's going to be invested in. They may invest in something that you would never invest in. but you don't have that option. You don't have that control. So that's something you need to be aware of. You are a creditor of the trust and not an owner in the trust. The cost is 1.5% of the first million, and then 1.25% of everything over that million. That's the upfront cost. Then annually, it could be 1 to 1.5% annually for the management of that. Now, we tell people there is an easy as 1, 2, 3 strategy when it comes to rescuing failing exchange. You have to set up an exchange with an accommodator that will cooperate with tax code 453 options. You look for your 3 properties. If you want to, you could designate a Delaware statutory trust as a third replacement or as a backup option as a replacement. And then if nothing good and acceptable comes together, then rescue the failing exchange with the tax deferred cash out or with the other strategies that follow tax code 453. But all of this hinges on hiring the right accommodator or intermediary to begin with. We've had people call us saying, I'm with IPX. I'm sorry, they're not going to release the funds. So typically, accommodators do not release the funds to other accommodators. So this has to be set up before closing. Now, what if you've already closed on a property and you did not try to do a 1031 exchange? Well, that's where you can look at qualified opportunity zones, or opportunity zones, as most people call them. You can take the gains from sale of stocks, bonds, real estate, interest, and partnership. You can invest the gains only and retain the basis. This is not normal. To be able to retain the basis, everything you put into it, you get that back, and then you put the gains into the tax deferral strategy. This defers the capital gains taxes for the current sale. So if you sell the property today, the tax bill that you owe today is deferred until 2027. People think that if they haven't invested for 10 years, they won't have any capital gains taxes. I actually thought that until I did my research. So don't feel bad if you're like me on that. The taxes are deferred until 2027. Then those taxes become due. So you have to really look at the opportunity zone property that you're moving into to make sure you get enough money out of it in time to pay those taxes. Then once you buy into that opportunity zone fund and the property, then the gain starting today, if you keep it in there for 10 years, then those gains starting today will be capital gains tax free. So you still have to pay today's gains in 5 years. Monies must be invested into the opportunity zone within 180 days after the close of escrow of property or stocks, whatever investments they are. So you have 180 days after you sell to put the funds into an opportunity zone. And typically, the opportunity zone funds are going into ground up development or into existing properties that need to be substantially improved. These are going into areas that need to be revitalized. There are 6,000 of them in the US. So that was the purpose of this, is to revitalize areas that were hurting pretty bad. Limitation, you have to be an accredited investor again. And again, there's companies that certify that accreditation. This has to be done separate from a 1031 exchange. Most of the information and tax professionals I've talked to say that you cannot start it as an exchange and move into an opportunity zone. If you find somebody that says, oh, we could do that, they have to be the ones that back you up if you get audited. So you either go into an exchange or you decide to do an opportunity zone fund. Because ground up development or substantially improved properties typically are not going to be qualifying for as an exchange. You can invest the long-term and short-term capital gains into this, and there is a limitation of benefit. As far as I know, California still does not recognize the opportunity zone fund, so you're still going to have to pay the California state taxes. If you want to know more about this, there's a great site, the irs.gov. If you go to the FAQs on opportunity zones, that's where I learned a lot initially, was reading through that. Still to be researched more thoroughly is the family and legacy endowment plans, where you can make a sale in a year and get the tax deferment. They typically require transactions of $1 million or more and about 6.5% cost, but we're still have to vet out the legitimacy of that from a tax perspective. So in the future, we may have more information on that. Now, how to pick a strategy: numbers, goals, and personality. That's what we always look at. The numbers have got to make sense. The cost of the strategy has to be a lot less than the tax bill. So if the tax bill is $100,000 and the cost is $84,000, it doesn't make sense to do it. So we have to look and make sure that the numbers fit. The goals, what are you planning on doing with it? But some of these strategies, you actually have to be putting into business or investments. And that might not be your goal. Your goal might be to buy a new car and pay off a primary residence. So we have to look to see what's going to help you to best accomplish your goals. And then personality. Some people would rather pay the tax and not have any restrictions and not have a future tax bill coming. They'll sleep better doing that. Other personalities will take every penny and leverage it to grow their estate. And then they'll look at the people who are willing to pay the tax bill and think that they're idiots. And actually, this is not a maturity issue. This is a personality issue. We are all designed differently and think differently. And we try to kind of work with you on that to make sure that you're not getting into something that you're not going to sleep well over. And that's important. DeferthegainsTax.com. That's where you will find a lot of our information. Last, there is an income tax mitigation strategy that where we can do what's called a 4-to-1 leverage deduction to reduce your income taxes. So if you're in the top 2, and in some cases top 3 income tax brackets, we can help you to actually mitigate some of those taxes. This works well, especially well for those of you who are in states that have a state income tax bracket, because here in California, you could be paying 50% of your income in the top bracket to taxes. That's a huge hit. We could take $50,000 and generate a $200,000 taxable deduction. That can be used up against 30% of one's income in a year, and any excess allocations can be carried forward for up to 5 years. I'll go back. 50,000 is the minimum with a group that we work with. So that doesn't mean that's all you do. If you're making a lot of income, $1 million, $2 million, $3 million, like some of our clients, then you can go higher, but that's the entry level. So really, you want to talk to us to make sure it makes sense from a numbers perspective. How does it work? So a minerals LLC has purchased minerals in bulk and held it for over a year and a day at least. They'll buy things such as gypsum or magnesium. Last year it was magnesium. This year is volcanic ash. They'll buy it from a commercial company in a significant bulk price discount. So they'll buy $25 million or $50 million worth in an incredible bulk discount, because the commercialization company is looking for an infusion of cash to buy more equipment. Then you join the LLC with a cash contribution. So in this case, $50,000 to start off with. You will receive LLC docs and vote to receive the minerals or donate them to charity. So you'll either decide, do you want 6,000 gallons of volcanic ash in your front yard, or do you want to donate it to charity? Then the next year, by March 15th of the next year, you will get a K-1 distribution along with an appraisal at actual market value. So they bought it in bulk. They've held it for a year and a day so that the deduction can be based on actual market value instead of purchase value. They're going to convert it to gallons for each individual member. So you're going to be donating it based on the gallon price, and they can guarantee a 4x or 4 times return on investment or donation in there. So $50,000 turns into a $200,000 deduction, and you'll get all the docs by March 15th of the next year, and you file that for your taxes. It has to be done by December 31st to account for this year. Now, a $50,000 purchase can save you up to $74,000 in federal taxes and up to $26,600 of state income taxes, depending on where you live. So if you're in the top tax bracket in California, $50,000 will save you $100,600 in taxes. So the net benefit is $50,600 in the top bracket. There's typically a limited amount of product available because they bought it last year. So once the members, they have enough members to cover all that they purchased, then it's done. So it's first come, first serve. And we've already opened it up. And right now we're thinking that they will, it'll be all bought up by the end of November. So first come, first serve basis. People ask if these qualify for continuing education for real estate, and the answer is no. So if you subscribe to our YouTube channel, you will, at Defer the Gains tax, you will receive $100 off of your first 1031 exchange, and there will be information that will go out later for that. Now, last thing here, we have what's called a complex spendthrift trust presentation next week at 10 o'clock Pacific time, 1 o'clock Eastern time. If you have a QR code reader, please feel free to pull it up and register. Ruth has been posting the link to this webinar as well in the chat box. So if you want to join us, you'll learn about that dynasty class of trust where you can have the asset protection and the continual capital gains tax deferment. Actually, you could eliminate the need for 1031 exchanges with this type of trust. That's how good this is. And then if you have businesses, you can reduce the income taxes. So you are welcome to join us with that. And we can open it up now for more Q&A. So Ruth,
all right.
I see the smoke coming off those fingers. I'm sure she was typing like crazy. And Alexandra. And so thank you, Alexandra, for having us do this presentation and putting this on for us. We really, really appreciate all that you do and have done for us. So,
all right.
Thank you.
So there was a couple questions, Scott, that came up. Chris wanted to know your opinion on transitioning from a 1031 DST portfolio into an 721 UPREIT option. He said he's 55. So that's something I wasn't sure of. So I didn't know if you had any thoughts on that.
Now, DST being the Delaware Statutory Trust.
I'm assuming, yeah, because it's 1031 from it, yeah. Into a 721 UPREIT.
UPREIT. I'm not strong with UPREITs, honestly speaking. We usually don't get involved with those, but the first thing you're going to have to find out is there going to be a problem with you actually exchanging out of your DST, because you have to look and see how much time you have to be in that to really get the value, because there's a lot of costs. So that's the other thing. You're going to have a cost of getting out of the DST, and you're going to have the cost for the UPREIT. So you have to look at all of those numbers. And at 55 years of age, if you're doing that for tax mitigation purposes, I would really look at looking at the complex trust and getting the tax mitigation from that and giving you a whole lot more flexibility, because at 55 years of age, you're thinking about other long-term things like long-term care in the future and all of that. So you might need more flexibility. Feel free to reach out and set up a time and we'll chat on that.
Yeah, I do have a consultation poll pulled up. So, this would probably be easiest if you want me to connect you with Scott and Ruth, because I'll know if you answer yes to this, and then I'll forward that information along to them so they can do that. And also, if anybody exits, please take the exit survey. So we have some excellent questions in there and that we want you to answer for us. Let us know what we should be doing and focusing on for next year. So just wanted to throw that out there before we move on to other questions. I'm going to end the poll. I think we're pretty close to everyone answered. And then if you didn't get a chance to answer it, I'll email a link to Scott's calendar as well tomorrow with the recording.
And please remember, everyone, this was a lot of information. A lot of it went like this. The goal really wasn't to do a deep dive as much as it is to help you to know there are so many options out there, and people are just shocked to find out. And so now we can do a consultation, really get into your case more. But this is to let you know there's a lot. And so, and your CPAs don't know all these.
All right. So I promised Andrea I would answer her question because she put it in the chat box, and it was one of those questions that I probably would have had to write a book if I was typing it out. So I said, as soon as you were done speaking, I would go ahead and address it. So her question was, it says, my LLC partnered with another LLC to form a third LLC to buy a 5-plex. We have it under contract to sell at the end of the month. We bought it for $200,000, which I put in all the funds. We used a $275,000 construction to rehab it, and it went a bit over. The selling price is $875,000. I'm supposed to get my equity back when we split the profits. And then she says, I do not have any properties lined up to 1031. I want to put the money into a JV or syndication for larger multifamily. How do we do this to defer tax? So now you see why I said I need to say it. I can't just type it. So Andrea, this is what I'm saying when I was replying in the chat box. You cannot get your equity back when you split with your partners in a 1031 exchange. So what I was suggesting, that since you put the cash in, if you did this under the LLC, but you record a note for the amount of cash you brought in as an individual, so now the LLC owes that money back to you, and now it can sell and do an exchange. Now, yes, you can go into a syndication or a JV, but you have to acquire title in the same name that you sold. Does that make sense? I hope, because she asked me to explain it. So if you have any questions, just reach out to us. I can walk you through it. Oh, she says, okay.
Yay. So, that sounds hard.
Yeah, my brain's going, oh my goodness.
I think I followed some of that.
That's why I'm trying to type it in, and in the chat box, it's really hard. So I told her, just give me a minute to explain it.
Well, when you got a professional that's been doing exchanges for 30 years, she's seen everything just about. So.
And there's a, if this happens, then this happens. If this happens, then that happens, you know, so it's hard to give all the scenarios. All right, so Scott, let's go back to your questions. I got Andrea taken care of. What is the average ROI of a DST? How do we know the actual values, as it probably fluctuates over time?
Great question. So you're going to see in offerings a range of 2 to 6% on most of them on the cap rate. And so, and right now cap rates are not looking super great. Anything in real estate right now, this past year's been horrible. So usually 2 to 6. So I've seen stuff in the 4, 5, 6 for our clients, but we don't set those up. We have a professional who's done over $1 billion of transactions that we can connect you with. But yeah, so 2 to 6% passive income. But they're seeing good growth in terms of the appreciation of the assets.
All right, another question. I am in my 70s and have 2 6-flat buildings. I live in one of them. I have 2 adult children that will inherit them unless can find some other way to dispose of them and minimize taxes. Recommendations? This
complex spendthrift trust.
Mm-hmm.
Reach out to us. We could set it up to put the assets into the trust. You can sell those assets, and you'll have that could pay you all of your bills except for fun, food, or fashion. And so a lot of flexibility.
All right. Melissa asked, how do you finance properties into the complex trusts?
they actually have lenders that understand these trusts. And so that work from a different perspective than your typical, let's look at my income type of thing. So they do have lenders that.
They do. And in some cases, you can take the property out of the trust, do a loan, put it back in the trust, depending on what you're trying to do. I think I hit everybody. I don't think there's any other questions, you guys, unless anybody else wants to add one in.
Hey, and we made it in an hour.
I'm impressed.
Just in time.
I am so impressed. Ruth, you answered a lot of questions. I did this time, you know, based on other people's suggestions last time, I made sure to make all of the answers visible to everyone. I wasn't aware that nobody could see that, even though in the last webinar. So you can actually go and into the Q&A and see, you know, what questions have been answered. There's also the chat. So what I'll do is I'll probably, you know, Ruth, since you did such a good job answering them and typing, I'll probably send that to everyone in the email tomorrow as a document, if that's okay.
Absolutely.
With you. Okay. Because there were some great questions in there. You answered really nicely and quickly in the chat. So I'm impressed. Yeah. And Janet, we won't be sharing the presentation, just the recording. So some legal reasons there on that. I know we have some speakers who don't also share it. So, but at least you'll have the recording so you could pause it, you know, and write down notes and that kind of thing. So I'll send that out, screenshot it. Yes. And then, you know, we'll send you that recording link by end of day tomorrow. Check your spam or junk mail, please, because I know it's automated. And so it's not coming directly from my email. So you might find it there. And then also, Ruth and Scott will be sending you an email too, separately, where they're going to give you some more free resources. We just talked about that before the webinar, and I think you'll find some helpful things in there. They won't do anything with your email unless you want to opt in to receive further communication. So just, you know, one-time email and you'll get a bunch of goodies in there. So I think there might be a couple of other questions that came in while I was going on and on. I don't know if you want to take a look at them, Ruth.
I did. I answered. One of them was that she closed in August on a property and was never given any of these options, anything to do now. So I gave the opportunity zone to take a look at that. Morgan says, too bad we are in California. We're all suffering here in California. But all right. And then other people are just asking for the presentation. So I think we've got everybody's questions answered.
So, and Morgan, feel free to reach out to me, because depending on your income plus your gains, that minerals opportunity might still have some benefit. It won't be huge, but anything that can be saved is, you know, helpful, right? So I don't mind taking the time and talking that through just to kind of get a feel for what you got.
Okay. Well, thank you, everyone. And thank you guys for coming on and talking to our group again. And yeah, we'll be in touch tomorrow with the recording. Have a wonderful day, everyone. Bye.
Thanks.